Hi, good afternoon, everyone, and thank you for joining us at Mirai Asset. Today we have Miss Kruti Chheta with us, fund manager and fixed income analyst. Welcome, Kruti.
Thank you, Tanya. Thank you, everyone, for joining us.
Right. So today we are here with a very interesting topic, navigating the next move. The context for the same is recently, just yesterday in the late hours, US FOMC, the US Fed predominantly, Federal Open Market Committee, made a decision regarding US Fed interest rate, whether to were making a decision, and the decision is to hold on to the interest rates for now. So, in that backdrop, let's understand what's the impact of that decision and what's the impact on fixed income markets. And for the same, we'll be heading over to Kruti. But before we know more on it, as investors, let's understand that why it matters us. What's something that's based out of United States. Many of us assume that, the decision is based out of United States. So what or how could it impact me? Or, further, what little impact could it have on my investments, right? So the US FOMC's decision have a multi-layered impact. Globally, if one has to talk about the changes in the Fed's rate policy affect the liquidity, investor risk appetite, and as well as allocation of the capital of a lot of institutional investors. Not talking about the Indian economy, what impact could it have on India or has in India? These decisions can, alter the rupee strength, have an impact on the currency rate, influence RBI's also policy decision, the MPC decision, and could also similarly impact investors' risk appetite and allocation of capital of, also the domestic players. And for investors, particularly fixed income investors or also equity investors, what implications could it have for them? The US policy tends to, either boost the bond prices or and support which further supports the enemies or add on to the volatility from changing capital flows that we discussed on a global and a domestic level. Thus, the valuation adjustments also happen. So, how it matters you in the nutshell, this decision sends ripple effect across the global financial market, and its impact is felt keenly by investors worldwide and particularly those in India as well. So now let's understand, what was the economic backdrop in which the US Fed took this decision. So the consumer sentiment had declined to a 29 months low, and likely from the effect of, the ongoing implementation of new tariff policies, the government restructuring efforts, etc. Even the recent inflation data called as consumer price index data that had offered some encouragement, as it was moving closer towards the Fed's targets. However, it's a little uneven. Say the food inflation is not towards the particular target of the US Fed, and it varies across different sectors of the economy. And the unemployment rate that had gradually started climbing up. However, it also still remains, in the range-bound levels of the US Fed that has been set by them. So, in the nutshell, the consumer sentiment as well as the business sentiment was a little weak, at the time when the US Fed was about to take the decision. So, naturally, what were a few expectations of different stakeholders a day prior to, this decision? The expectations were regarding, there was a lot of uncertainty that, were how the US Treasury would manage the debt issuances over the next few months, or what the decision the Fed would be making, whether it will be prioritizing to save the economy from a slowdown, or it would be prioritizing inflation and would want to keep it in check. So what would be the decision be like, and what would be the economic projection. So US Fed every alternate economic policy wise in a calendar year also comes up something with a projection or a dot plot wherein it projects the longer term and next year's interest rates or the US Fed rate as well as the GDP. What likely could the GDP growth be? What likely could the inflation be? And as we all know, before such economic high frequency indicate frequency, data points, the markets are a little sensitive. So naturally, the markets were sensitive, and they were looking forward to the future guidance of the US Fed. So now that I've explained the entire context and the backdrop, over to you, Kruti, on taking us through the entire decision, what impacts it could have, and ultimately, what should investors do? What funds should they look at in the fixed income space? So over to you.
Thank you, Tanya. That simplifies a lot my job to explain that what the decision was regarding. So, as Tanya has mentioned before, there were few indicators in the US economy which was pointing out towards the weakness that, immediately if it's not being shown in the hard data, the sentiment overall is weakening. And this is happening because of lot of turbulence that the government is taking decisions over there. So, in hindsight, the expectation was that because of the turmoil or turbulence that is happening in the US economy, the Fed will maintain the rate for this policy. But there was a bit of a skepticism in the dot plot, as Tanya mentioned before, that every alternate policy they come up with a dot plot where they give the forward expectations where they expect the rate to be. So there was a skepticism where the dot plot would it be maintained at a 50 basis rate cut, which was there in December, or there would be no rate cut at the in this dot plot. So in this dot plot, they have maintained the rate at 4.5 and maintained a 50 basis rate cut in the second half of the year. Second, towards the forecast, there was an expectation that the inflation would go up, which they have. They have moved up the inflation by 30 basis points, and the growth they have moved down by 40 basis points. This again comes up with the policy decisions that are being made in US. And then they have touched base a bit upon the uncertainty over the tariffs. So even though if we see that the dot plot is maintained, there are three members who said that there could be three rate cuts, but majority of them said that there could be no rate cuts or there could be only one rate cut in 2025. So that is where the median has been maintained, but most of the policy contributors, they have moved towards say that there could be less rate cuts because they're very skeptical in terms of the inflation. And then we have seen that quantitative tightening has been slowed down. So essentially, what does quantitative tightening means that the Fed balance sheet that was there, Fed was not buying in new securities. It was either letting the securities which they are holding in the balance sheet mature and not buy back, or either they were not buying from the market. So now they have decided that since there is a tightness in the system, liquidity which is showing up in the system, they would buy back the securities whatever the quantum is maturing, and they've committed that they will buy towards the longer tenures rather than the shorter tenures. So this means that the balance sheet which they were running down, or they were shrinking the balance sheet, that would increase again because they will buy back again. So moving, these are some of the highlights of the policies. Moving to the future trajectory, that what guidance they have given. So, like pointed out, they have still remained on the two rate cuts, but there has been variance in what the expectation has been there, with majority expecting that there could be one rate cut or either no rate cut, and there are only three members which are expecting three rate cuts. Out of everyone, it seemed like Chair Powell was the most dovish one, because he said that, this policy, the tariffs are supposed to be treated as transitory. They want to rely more on the hard data rather than the sentimental data, because most of the times what they have observed is that the sentiments does not, always turn into actual hard data. So they would want to rely more on the hard data rather than the forward looking sentiment data. They if you see, there has also been an inclined towards increase in the inflation, which is moved up by 30 basis point. But here we have to see that there is been a revision in the inflation and the growth, and these are factoring in what is to come forward. But one thing that has not been factored in to a larger extent is your unemployment rate, because that has moved up only by 10 basis point, considering that there is lot of shuffling happening and there are layoffs happening, or the hiring rate is not at the similar levels which the forward looking sentiment is also showing. The unemployment rate seems to be a bit of undershoot right now. And if you see, even GDP by 40 basis, given that on April 2 there could be implementation of tariffs, might be an undershoot. But again, as we have seen, the sentiment has remained about pause and wait and watch, and they would actually want to see that how the policies pan out and what the hard data says, and then take a decision on it. So this is what the Fed is looking at. They are largely on dependent on the hard data and wait and watch mode. So what do we derive out of this, or what is our take from the entire situation and fixed income markets? So dovish tilt, definitely, because largely the market was expecting that there could be some of the hawkish tilt, given that there is a lot of announcements that are taking place. There are tariffs which have been implemented or are going to be implemented, and also there are retaliatory tariffs which are put by the other economies on US also. So there's a lot of uncertainty. However, if we see in the press conference, this uncertainty has been addressed very beautifully and been said that we would like to see that how this pans out. Also mentioning that the inflation due to tariff could be transitory, and if it is one time thing, then it can be overlooked and should not, lead to largely changing the policy decision. That has been more on a dovish tilt than hawkish tilt, that if there is an inflation, we will reverse or take a pivot and go back to rate hikes. They have addressed the liquidity tightness very early on. And we see that towards the end of the year, the quantitative tightening might completely disappear from the Fed's narrative, and we might, if not quantitative easing, we might move into a territory where they are providing adequate liquidity into the system. This is also forward looking in a way, even though they have mentioned over and over again that this is a liquidity measure, this has nothing to do in with the policy rate, but there is always an impact of liquidity that has been provided into the system that helps more of the buying of the government bond. This boosts the demand of the treasuries, and this will in turn help boosting the rates of the treasuries, if not directly, indirectly also. Also to mention relating to this move might also have come in the sight that in next 3 years, over 50% of the US treasuries are maturing. And if there is a demand that is to be created, Fed would also have to participate in this. And that's why this could be an early indication that to absorb the demand, they have, stopped the balance sheet runoff. Also, the past balance sheet that the Fed has been running and the rates at which the current interest rate is running is at 3% of GDP. If the new issuances are to come at 4% or 4% and above, the interest cost for the US goes very high. And because the interest cost goes high, the interest cost as a percentage of GDP would surpass 3.5%. Fed and government are cognizant of it, and probably there could be some measures around that to lower the interest rate cost for US also. And if you see the current administration, that is the Trump government, is focusing on trade, immigration, fiscal, and regulation. So there are a lot of changes that are happening. There is a lot of buzz over the fiscal, and they want to narrow the fiscal. But as per current situation, can they really move down drastically on the spending? Looks bit of a skeptical. They need to create more revenues rather than focusing on how they can cut down on fiscal, because the mandatory spending for US government is pretty high. It's 70% plus. So there is a 30% maneuver to cut down on the fiscal cost, and out of that 30% also around 50% is in defense, which they are speaking that they want to increase the defense expense. So that leaves a very little space for cutting down of the fiscal spending. With the fiscal staying at current levels or narrowing a bit, again interest cost becomes a concern, and they would be looking at decreasing that. Second is that there is a lot of focus on immigration also, and because of fiscal cutting down, there have been some measures that have been taken by Dodge, that they want to cut a number of employees that are there with government. So this leads to cutting unemployment, increasing in the unemployment, which is why we touch base upon that the unemployment rate has not been moved much. It has only moved up by 10 basis point, which seems to be an undershoot in the projection, and this could be revised up. Before the next policy, there are many readings that are to be come on the initial jobless claims, and unemployment rate would also come in. So this could set tone in the next policy where we are heading towards. The weakness is already there, and if there is a persistent weakness in the data reading that is coming until next policy, we see that this dovish tilt might go more towards dovish, because for any central bank, there are things, actually three things which are very important. One is employment, second is your GDP growth, and third is inflation. Out of three, if two are taking a hit, that is, if your growth and unemployment are taking a hit, then there would be an action which would be required. And we have seen this in 2024 also, that Fed started off with a positive projection that it would cut rate by 100 basis points. Middle of the year, they went to about a 50 basis cut. And towards the end of the last year, we have seen that there has been a drastic rate cut. So whereas last year we saw that Fed was more committed to the trajectory and reiterating that, we would follow this trajectory, whereas they kept changing the trajectory. This policy, they have changed the narrative and said that we will go with the flow, and as and when the hard data indicates, we will take the action accordingly. Therefore, from here on, hard data does matter, but eventually it boils down that there is a dovish tilt which is there. They're expecting that growth and unemployment would see a drastic slowdown, which would need more measures to be taken. Effects from the tariffs are still unknown. Even they say that it is very hard to predict that how much impact will it have, but they're ready to take it as a transitory increase and not react on it much. Therefore, we see that it seems to be the next trajectory that Fed will be providing will be more on the dovish side, with maybe two rate cuts or like a three rate cut that would be coming in the second half of the year. Having taking these things into perspective, for US markets, obviously it seems that because the quantitative tightening is in place and there is going to be more buying by the Fed in the longer end, there is an expectation that the longer end of the yield curve would move down. And in India, because we are seeing a growth slowdown, we are seeing that inflation is around 4% and expected to be around 4 to 4.5% for the next entire year. We are expecting that this would, and now that Fed also has given a stable policy, we are expecting that this should set a comfortable trajectory for the RBI to now focus on the domestic factors and go on the trajectory of rate cut. Therefore, we expect that the mid and the long term of the curve. So mid means, we mean that 3 to 5 year segment of the corporate bonds and GSEC should be performing well. And then if anyone wants to take a strategic position, they should go for a long-term fund, because we have seen in last 1 month that the duration has performed, and from here on, if there is a further rate cut trajectory which looks more likely to reap the benefit of risk and reward, they should be going for a long-term category where they can maximize on this rate cut cycle. So this is briefly what we think that, the situation is going to pan out as.
Sure. So thank you so much, Kruti, to take us through very quickly and briefly over the decision and its impact. So on a lighter note, in the entire US Feds, the Chairman Powell's speech, it was 43 times that the word uncertain was mentioned. So quite uncertain times we are in, but however, it's these uncertain times, viewers and investors, that makes, sets the stage for opportunities. So to summarize everything that Kruti said, that, even though the rate has been not cut as was anticipated, actually the anticipation was much on the, side that, maybe the tighter policy could happen, and this stability that came out in the tone of the speech, that actually, sort of neutralized the markets, cheered the markets, if I had to say. So
Right.
investors and viewers, you can type in your questions in the chat box we have. So Kruti, before, we take questions from the investors, I have a few questions of my own to ask you, especially on the markets. So, with the FOMC's decision to, pause on the hikes right now, how it influenced the global bond markets, particularly the US yields, and also how it today impacted Indian yields, if you can brief us on that.
So when we are talking about US and we are talking about its implication on the global markets, we have to understand why US is important. Now, one sole reason why US is important is because the global acceptancy of US dollars is there, right? When we trade, we import, export, we do it in US dollars. And therefore, any decision that is taken over there, it becomes important for us, not only on the interest rate trajectory, but also in the currency markets. So if had they been hawkish and had they said that they would increase interest rate, you have to think in terms of an investor, that if Fed is giving a higher interest rate and it's considered as a safe haven, the investor would rush on over there. That would lead to selling of the rupee. That would lead to selling of the bonds in the Indian market, saying that if I'm getting that interest rate over there, then why I invest in Indian markets? But the whole idea of having central banks, having regulators, is that they give your commentaries and they ensure that there is a stability in the market. That's precisely why they release the financial stability report also, because they want stability in the market. So if you see, the expectations are also very widely set, and usually it comes in line with the expectation. There are less surprises that are there, and that's what happened in this policy also. So largely because the policy was delivered in line with the expectation, but the quantitative tightening provided an extra, the runoff of the balance sheet provided extra cushion. We saw that the US treasuries rallied. And one of the reasons was also that, they maintained that there could be a 50 basis rate cut in the second half. The US treasuries rallied. As for the India market, because it is linked, we saw a slight positive opening, but it did not rally to the extent of what the US market rallied, because in India, we are expecting our own measures and own policies to play out at this point of time.
Right. And the RBI policy is also due next month. So
Right.
we all have our own. Now, how the countries are divided, viewers, what we see is that, when we started at the peak of rates at 2022, there was a common enemy of inflation in a post-COVID scenario. Now, the problems, the issues due to which the triggers for central bank decision making is very much domestic, it's very much local.
Right.
So yeah, now on to questions and answers. So, Kruti, the first question is that, what are the implications of a stable US interest rate on the emerging market debt flows and investor sentiments?
So, like mentioned, and we have over and over our conversation, is that US is a big daddy. If there is a stability in US, it allows the emerging markets to decide better and concentrate on their domestic economies. If there is more volatility that is there in US markets, then we get affected in terms of currency, and it makes our job difficult in terms of, taking decisions, because we are always at a mercy of how much currency volatility would happen. That is precisely what happened from mid of December till almost, mid of February to Indian markets, that there was a lot of volatility because of the announcements that were coming in US. Now, if there is a trajectory which is given, then the investors know that which way the policies are going to go, and they can take their decision accordingly, that where they want to invest. Having a foresight of, how things are going to go helps investor, and in turn that reduces the volatility in our markets, and we see that less of the FII shocks are given into our economy. So therefore, we have our domestic factors, and there is a strong retail hold that we have in our economy also. But because there could be some volatility in currency and FIIs coming in and out, a stable policy over there helps us concentrating on our own problems rather than being worried about global, developments.
Sure. So, Kruti, another question is, what impact could this possibly have on the currency? And let me ask a second part to it. Not only just INR USD, relation, also on other major currency. I understand, USD is the most pegged to currency. But, in comparison, say, to other developed markets, what impact could have? And, of course, on the emerging markets, how currency could be impacted in these two segments, if you can brief us on that.
So again, like we mentioned, that the job of the central banks and the regulators is to stabilize. This is what precisely central FOMC Fed has been doing for such a long time. So their decision is not making a lot of impact on the currency as of now. But there are major other announcements that are right now making impact on the currency. So for example, right now all the currencies are not directly linked to the USD. If you see Japan, because there is an increase in the interest rate that's taking place over there, there are a lot of investors which are going to Japan and their currency is doing better. In Europe, if you see, because there is a lot of chatter around the spending on the defense that is going to increase, there are a lot of investments happening over there, and because of the inflows going over there, we are seeing that euro has also appreciated. Similarly, if you see other currencies, so for INR there was lot of outflow that happened because we had not depreciated for a very long time, but then the volatility came in and there was a fear of tariffs that was there. We tumbled for 2 months, we covered up all the depreciation that was due, but now we have stabilized, and we've seen that the dollar run also now it has stabilized from peaking out. So there are various factors that go into the currency, but if you see the decision of FOMC or any other regulator, now incrementally it aims at stabilizing rather than creating a volatility in the. But how if this had gone towards the interest rate hike, then we would see that there could be some volatility with dollar appreciating and other currencies depreciating.
Right. So, Kruti, in your recommendation, you also mentioned recommending, on the long duration fund size in this category. So there's a follow-up question on that, that how does this fund, work for investors? What kind of potential incremental returns? Well, no, I understand you will not be able to speak much on the performance, but how does it works for the investors, and particularly in such a scenario, where the rates are declining, we're in a rate cut scenario throughout the world. How does it, work beautifully in such a scenario? If you can, just touch upon this.
Let us take a very simple example that when you are investing in a security, in a fixed income, what do you look forward to? You look forward to the coupon that is the security is going to dwell. Now, the beauty of the fixed income market is that you get a mark to market gain also. How that happens? Let's say that today you have invested at 7.7% in a security. Let's forget fund. Let's take at a security level that you have invested at 7.7%. Now, government RBI comes and says that there is 100 basis rate cut. What leads to? This means that this 30-year security, which was giving me a coupon of 7.7%, now that has come down to, let's say, 6.7%. So the new issuances are happening at 6.7%. But because I'm holding a security which was giving me 7.7%, investors feel that the security is premium because I am getting a fixed coupon of 7.7%. And because there is a higher accrual which is this security is giving me, the investors would come and ask me for a higher price for it, because this secures their coupon of 7.7% for next 30 years, or let's say 25 years that is there. So it suddenly becomes premium. So what I bought at 100 rupees, the investors are asking maybe 102 rupees for that, trying to compensate over the long period of time that I am okay to pay 102, but I will get a 7.7% coupon for next 30 years of my life. So the beauty of investing in a fixed income market and a long-term security is that you get the MTM benefit. Now, linking it with duration, just to simplify it, that if as an investor you are investing in a 1 year security, and if the interest rates are going down, the gain that you're looking at by asking for the premium for that security is short run, it is only 1 year. That is why the premiums would not go very high. But if you as an investor are looking for a longer period of investment, and you are saying that I am ready to do like take a 30-year investment by giving that premium of 2 rupees, for a shorter, you won't give a premium of 2 rupees. Probably you'll give a premium of 10 paise or a 20 paise. But for a longer, you will give a longer term premium. Therefore, in a interest rate cut situation, to gain for the higher premium, you should take an extreme long call, because there is a certainty of a higher premium over there.
Right. So at this point, when the yields are currently, at a relatively higher levels, it looks a good point to, go towards longer duration mutual funds to, lock in higher or better yields. And, then you get investors double benefits. You also see appreciation on the bond pricing that's, underlying instrument in the fund. You also see those yields are probably could not be present going forward. So yeah, to summarize on the long duration one. So another question that we have is what are the implications for the Reserve Bank of India's monetary policy? Will it continue with the current stance, or adjust rates in response? So what's your view on that, Kruti?
We have seen that, in a longer run, the Fed decisions are followed. But since COVID has passed by, where there was one voice and one concern, things have changed drastically. Not to say that it is completely ignorant, but the economies have taken a divergent path. So there are some economies which are at rate hike cycles. There are some economies which are cutting deep, and as for India, because we have so much of domestic stability that we have created in last few years, we seem to be in a good position to concentrate on our own problems. Now, this can only happen if our currency is supportive. It seems to be now that the pain from the currency is over, and we can stabilize and concentrate on our own problem. So, last 2 months has been a firefighting with currency and holding it up. But from here on, it seems like we can concentrate on our own problem, which is the GDP growth with comfortable inflation and comfortable balance of payments so far, and we hope that it remains that way. So from here on, Fed and to just point it out that we started the rate cut cycle before Fed, and
Right.
we started the rate hike
Good
cycle
hike.
much before Fed, and we started cutting much after Fed took the
Right.
decision. So we started taking our own decisions and seeing domestically how we are panning out and what is the need of the situation. This should persist. We should be concentrating on our own problems, because now we are very strong on the macro front, and the stability persists. But having said that, if there are volatility from Fed, or there are changes in the narrative, that could tweak the decision bit, but as of now, it does not seem to be bothering in the longer run.
Right. So while directionally, RBI tends to move in the same direction as US Fed, however, due to various domestic factors, and it has its own objectives and things to achieve. So looking at that, it tends to take decision more because of those domestic factors rather than just because what US Fed is doing to just copy or follow that. Understood. So Kruti, just before we end the call, and in the session, I would just want one summarizing comment from your side on what should debt investors do at this point of time? What funds should they look at? How they should particularly react? Because, a lot of times the markets are very sentiment driven. So, what are your two views on this thing?
If you are an investor and there is a lot of uncertainty and global developments that are happening, there is one thing that always happens is that investors run to safe havens. What are the safe havens? Safe havens are government security, safe havens is gold, or safe havens is like, these are the two broadly safe havens that are there. Not saying that, other asset class you should not be looking at, but you should try balancing out your portfolio. Now, if I'm talking about fixed income in Indian space, then I would suggest that if someone is there for a short, who wants less volatility in the portfolio and want to reap the benefit of this rate cut cycle, can choose a mid, that is category of short-term banking PSU or corporate bond fund that suits in this cycle. And if you see the corporate bond fund, corporate spreads are yield curve is inverted. So there is a lot of benefit that investor can reap out of it. if the investor wants to strategically invest and reap the benefit of this entire rate cut cycle, it's already, the rally has happened in last 1 month, but there's still more to go in this segment. Then you should be investing in long-term fund and reap the benefit of this rate cut cycle, keeping in mind that, how there is more 50 basis that might come in this rate cut cycle.
Right. So thank you so much, Kruti, for addressing us today with the, not only briefing us upon the decision of US Fed, but also, finally telling the viewers, what you can do in terms of your portfolio for the fixed income space. And thank you so much, viewers, for joining us. In case, you want to know more about this entire decision, or, read what's Mirai at stake, we do come up with the Quiconomics note on US FOMC that's available on our websites or our social media handles. So do go through that. And thank you for joining us. Thanks, Vitan Kruti. See you next time. Bye
Thank you,
bye.
Tanya. Thank you, everyone.